Hello, this is Bill Friebel with Starfox Financial Services. We're going to do something new this time with our newsletter update. We're going to do it live via video. So hopefully you find this very informative and interactive as well. I'd like to introduce myself in more detail. So I'm also a partner with Jose Palafox and Starfox Financial Services, and I focus more on client services and some of the operations as well. So, and I'll turn it over to my partner.
Well, good morning. Yeah, it's quite exciting for us. Today's our very first video market update. As you guys know, over the years we've received them almost on a quarterly basis, but usually in written form or by email form. Today is our first try at this video, so hopefully you'll enjoy it. We're going to give you a small market update and some other information. Bill will go ahead and tell us what we're going to be covering today.
Absolutely. So we're going to get kick-started on everybody's favorite subject, tax reform. So that's a joke. So we're going to talk about what happened in the final hours of 2017 that's going to impact you beginning this year in 2018 and beyond. And we're going to cover key areas there. Then Jose will cover the market, what happened last year. We had a record year in 2017, and then what we see for the year ahead.
That's right. So we'll go ahead and cover real quick before we get into this extraordinary subject of tax reform. We're going to go ahead and cover what happened last year. As most of you know, the markets did really well. For those of you who don't know, the S&P was up 21.83% for the year. And actually, the international markets did a little bit better. They were up 27.4%. This year already, the S&P is roaring. It's up 6.3%. And we'll talk a little bit more of why that can be good and also why we think that plays into what we're going to forecast for this year. But we'll get started with Bill and the lovely tax reform that our government did over this last year. It's great news that it got done. We've had a lot of questions, a lot of calls, even from CPAs themselves asking us what we think and also how it's going to affect everybody. So Bill will cover that for us next.
Yeah, absolutely. And it is going to affect pretty much everybody. First of all, Starfox Financial Services does not provide tax or legal advice. So we got a lot of this information courtesy of our CPA friends and partners. And the bill is quite extensive. It's over 500 pages long. So there's a lot of details. And I'm going to break it down into key bullet points on the different sections. So first of all, let's talk about the tax rates and the brackets. So most everybody will see lower rates with the tax reform. So there's still 7 brackets, but all the rates are coming down. Specifically for people that don't itemize, because you have an option when you do your tax return. You can use a standard deduction, or you can itemize and come up with all these other deductions, charitable expenses, etc. So for those that are using the standard deduction, they're going to see that the standard deduction was nearly doubled for 2018. So that's going to be significant. So we're probably seeing fewer people itemize in 2018 and beyond. The highest tax rate did drop. So we know it was near 40% at 39.6. Now it's down to 37%. AMT is not completely away. Alternative minimum tax is what we're talking about. But there's a bigger exemption to make people less likely to be impacted by AMT, which is fantastic. Now, here's the thing that a lot of people aren't focusing on the personal side is this is not permanent, right? So over time, the tax cuts do fade and they're going to become net tax increases after 10 years. That's the way the Senate and Congress had to get the bill through and passed. They had to do some certain provisions. So in 2027, it'll become a net tax increase. One thing for people that were worried about estate taxes, the exemption was nearly doubled to 11.2 million and 22 million for people that are married filing jointly. So basically, I mean, over 99% of people are not going to be impacted by the estate tax going forward. Now, a lot of thing that's been getting a lot of press on tax reform was something called state and local taxes, or you heard the acronym SALT, right? Everybody likes a little salt on their food. Well, here's the flavor that comes with that. So state and local taxes for people that are in states that have the income tax, the state income tax, they're able to deduct the property tax and the state income tax but now they're capped at $10,000,
Right.
right? So that's it. So if you're in a high tax state, high property tax,
California.
in California, New Jersey, New York, coastal states primarily, that's going to be an impact. For people that are in no income tax states, you're able to deduct the property tax and the sales tax, but once again, you're capped to $10,000. So it doesn't matter how many homes you have, you're capped at $10,000 overall. So that's a big impact for some of those people. I know states are looking at what they can do there. So, and that was it. Moving on to kind of more at home for the family and home mortgages, the big impact is if you're getting anything new. So if you have an existing mortgage, the same rules essentially apply for your mortgage. But on new mortgages, the deductibility is only on a mortgage that's $750,000 below. So it's up to $750,000. Previously, it was $250,000 higher at $1 million. So, and that applies only on interest on a mortgage on the first and second homes. So, and that's it on the mortgage front. So if your existing mortgage, you're fine. If you're looking at a new one and it's above $750,000, you're not going to get that mortgage interest deduction. On families, the child tax credit did double. There's an additional for some dependents, and there's some different thresholds where everything phases out. The biggest thing that a lot of people missed is if you were moving because of job related, and if you move more than a certain number of miles, you could deduct your moving expenses. Well, that is no longer. So that deduction is totally gone. One new thing on the home front, people every year, they start talking to us specifically when they start getting the letters from college that their kids, hey, we're accepted here. Then they start thinking, how the heck am I going to pay for all this? Well, a lot of people have been saving, and one of the favorite mechanisms for saving is the 529. So that's a tax code where you can save after tax in a 529 program that's through a certain state. It'll grow tax exempt. You can pull it out tax free as long as it's used for that child or that beneficiary, higher education, room and board, right, and all qualified expenses. Well, they kind of changed it now. So now they allow you to use 529 expenses up to $10,000 annually per beneficiary from kindergarten to 12th grade. So it can be public, private, religious, doesn't matter. But now you can not only have that money, is that restriction that's for only higher education has been removed, and you can use $10,000 per year.
Which is great because now, as a parent, and as you guys, most of you know, I have 5 kids. I would have been able to use this while they were below their college age. You could use it to go to private school when they're kindergarten, when they're in first grade, second grade, third grade. Doesn't matter. If you have any kind of expenses that you can take out of your 529 and pay for those will be deductible, which is wonderful because now you can focus not only on just higher education, but even give them a little bit better education at the lower levels.
Absolutely. And if people have been saving for college for a while, some people may have been using a Coverdell educational savings account. New contributions into those are no longer allowed. So those are now prohibited. So 529s are the way to go. So if you have any questions about that, we'll be happy to answer those. Healthcare. Healthcare is a very interesting thing. You can see that they never repealed Obamacare or what's called the Affordable Care Act, but they started to kind of pick away at it. One thing they did is they eliminated the tax penalty for not having health insurance. Now, this only starts in 2019 and beyond, so it's not effective for 2018, still required to have health insurance. They did temporarily lower the floor of out-of-pocket medical expenses, and they moved it down to 7.5% from 10%. And that's for 2017, if you're doing your tax return, and 2018. So that's only a short-term effective deal. Another thing that's getting probably the biggest news about tax reform, and probably you're seeing businesses do announcements every day, is the impact on the business rate for businesses, including the self-employed. Because there's kind of two things going on here. So if you're a corporation, you're a C Corp, you're an Inc. company, you did have your tax rate lowered, right? It's down permanently. So this is not a short term, permanently from 35%, to the maximum, down to 21%. So it's a pretty significant. So that actually, instead of the United States for businesses being one of the highest tax rate companies, now we're down to the lower probably third of companies. So we're a lot more competitive there. And you've seen companies bringing money back. Now, if you want to bring money back, you have billions offshore like many companies do because they didn't want to bring that back. we believe there's about over 3 trillion offshore. They can come bring the money back. They pay a one-time repatriation tax, and the money's back here. And so that's one thing companies are absolutely doing. That's why you're seeing they're taking deductions and charges on their income statement, planning to bring that money offshore and invest it here, or to pay their people more. They're doing some, and some they're going to be returning to stockholders. For those that are pass-through entities and sole proprietorships, on some you may qualify for a 20% deduction on your income, and that's for a certain up to a certain threshold of income. And the other big thing, which was very popular and is very stimulative for the economy, is expenses. So if you're doing a major expense, you were able to deduct it in the first year instead of doing depreciation and amortization over several years. And that's called, a lot of people refer to it as Section 179 expenses. And now that has been increased to $1 million. So that is a perfect thing. So I know there's a lot of different nuggets, a lot of moving parts in tax reform. Those are kind of the most important areas of tax reform.
Yeah, the last one that we just covered, the 179 section, that helps because when you're growing your business, when you're buying new equipment, you can take that deduction all at once. You don't have to wait, 5, 10, 15 years to do that. So that's a great savings on your tax bill for that year. The other thing too is the pass-through affects somebody like us when we're an LLC. So before, all the income we made would be taxed at the highest rate that we qualify for. But now through the pass-through, they're going to give us a 20% discount on that rate. So just a little bit extra savings for us, which we think is wonderful for small businesses like ourselves.
Mm-hmm. Absolutely. So what do we have on the markets for 2017 and the outlook ahead?
So great, all that exciting tax stuff. Now that you've learned so much about our tax reform, one of the things that's kind of neat is that in our Rotary, as you know, Bill's in Rotary, I'm in Rotary here in the Woodlands, Texas. What's wonderful about that is Kevin Brady, the person that was behind this whole tax reform, is actually in our Rotary group. So I thought it was quite exciting. We actually got to go and ask him the 20% pass-through. I actually asked him face to face to explain that to me because I didn't understand it quite well. So I actually got it from the horse's mouth. Now, mind you, he still referred me to the 500-page tax bill, but at least I got to hear straight from him. So that was kind of exciting for us. What I'd like to do now is kind of go over what the markets are, where they are at, and what we're looking for, and what we think is going to happen over 2018. One of the things that's quite exciting is obviously this year has started out with a bang. A lot of it having to do, I think, with tax reform and also what I call people trying to catch up what they've already missed out on. We're seeing a lot of money flow into the markets today. It's actually up again today, and we're up 6.3% for the year already. Now, obviously, if you're invested, that's great, and we're very happy with that. But one of the things that's starting to worry us a little bit is what we call a melt-up. What happens in a melt-up is the markets will tend to have a lot of money chasing it at the end. People are chasing returns. One of the things that I get constantly is people coming in and say, well, how can I get in? How can I get in? How can I get in? Yet, if we look back to 2009 when the markets bottomed out, but when we were trying to get people invested, nobody wanted to do it. Why? Because things were terrible, everything was horrible, unemployment was high. But that's really when you want to buy these markets, is when nobody wants them. Today, unemployment's near 4% and probably going lower, which is great for the economy, great for people looking for work. But when we look at the data, that's when it starts to worry us, is we don't want to see the economy overheat, because a couple of things can happen down the way. First of all, the Fed is going to have to continue to raise rates, which they've already said they're going to. But if they get behind, they'll have to raise rates even further. If they do that, that can slow down the markets. They're looking, I think, at three rate increases this year. They got two things that they have to do at all times, and that is their mandate is that we have full employment, which I think we can all agree that full employment is pretty much there. And then obviously inflation is what they're also trying to make sure that it doesn't get too high. Inflation has been pretty low, and we've been very, very, very fortunate. Over the last 8-9 years, inflation has been pretty much nil. Slowly but surely it's creeped up and then back down. We haven't seen much of it there, but we think that it's starting to show. It's starting to see, it's starting to creep up over the last couple of quarters. If it continues higher, the Fed will be forced to raise those rates maybe even quicker than they expect. If they do that, that'll slow down what the markets are doing. Having said all that, our forecast is that the market could easily melt up between now and, say, the fall. Why do we say that? Because this is an election year, what we call midterm elections, If we look at the data from midterm elections, which I have here, previously in the last 8 or 9 of them, there's been corrections in the midterm year. The lowest correction was 7.1%, which was in 2006. If we go back to 1986, there was a correction of 9.4. 1990, it was a correction of 19.9. We were looking for somewhere between a 5 to 10% correction going into the year. As this market continues to melt up, that could easily get far more extensive. And now we're looking more like 10 to 20% correction, especially if it continues to go higher. What that means is, although the market will probably do well in the first, second, and maybe even third quarters, it could easily give it all back. To give you an example, everybody remembers, Black Monday. Well, Black Monday, when that happened, that was 22% loss in one day. Now, let me repeat that. That was 22% loss in one day. Not the year, not a quarter, not several years, all in one day. But what people forget about that year is that the market melted up from the beginning of the year, was up a little over 30% right up until that day when it all collapsed. So we're not saying that that's exactly what's going to happen or that we're even worried about that. But we do think that there is a breadth of a correction that's needed in order for the market to continue forward. And we're looking for that in our portfolios. We're invested with the point of view that we're going to get a correction. We have some cash on the sidelines ready to go to buy at those lower rates.
And speaking about Black Monday, that was back in the fall of 1987, right?
That's correct. Yeah. So, having said that, what do we like? Going forward, obviously the markets are melting up. Obviously, everything has gone up, especially over the last couple of years. There are some areas that I won't say are cheaper, but are areas that we like going forward because there's some value there. Obviously, financials are one area that everybody's talking about. We still like them. As rates go up, banks tend to do better. Financial companies tend to do better. So we do like that area. We like the energy sector. We're here in the woodlands where oil is just about everything. And for several months, people were saying, oh, oil's going to go back down. It's going back down, yet we're pushing above 60 now. And we think somewhere between 50 and 60 is a good number for these companies to be able to continue to make good profits. We like that area. We also like MLPs. We bought some of that last year. It's done really well. It's actually up over 7% since we bought it, and it pays about an 8% dividend. So it's done really well for us. So energy is a very, very exciting sector. We think it'll have some strength to go forward. We think it'll continue, especially as the economy does better. People drive more. They use more oil, obviously, more gas. So that's a good thing. The other sector that's for a lot of years now has done fairly well, but it's going to continue to do very well, we think, is the real estate sector. Real estate right now continues to be hot, and the biggest reason is shortage of inventory. Right now, as we look at the millennials who are turning into their 30s now, are starting to form households. They waited a little longer. I don't know about you guys, but I have a couple older kids that are still at home, and we do get that a lot across the country. The data shows that a lot of these kids that even after college are coming back and living at home before they actually start their household. But they're starting to form them now. We're starting to see that household. There's back in the 80s, we were building a run rate of 1 million homes. Now we're about 700,000, so we're below that. What that means is it continues to be a shortage of inventory. One of the things that might happen going forward is that instead of new homes being, the price going up, we might see resale starting to go up a little bit better because there's just not enough inventory being built, and it can't be built. And here's why. When you have an unemployment rate of 4% that we have now, the builders can't find the workers to build the homes. So if you can't build the home, that creates a shortage, and that's why we think real estate market will continue to do that. How we're using it in the market is we are buying REITs, and we're also obviously looking at any other area that we can find real estate in to invest in. I think that goes forward for at least another number of years. There's a lot of catch-up work to do in the real estate market. I was in California during the last real estate crash. Obviously, a lot of people are either even or just above even from when that crash happened. But you're starting to see the inventory shortfalls are going to continue to push prices a little bit higher. So we like that area. The other area that we like is commodities. Now, commodities is when we talk about commodities, we talk about gold, we talk about oil, we talk about a few other things. We are actually purchasing a little bit of gold in our portfolios. We do like it going forward. One of the big things about a market crash is that, generally speaking, you're going to get it just before a recession. So the market will tend to correct or crash when it sees a recession coming. Now, we don't see a recession in the near future, but eventually there will be one. What tends to happen is that commodities will increase in price as inflation starts and as we get the economy hot. So those areas we like a lot, and we'll be adding to the portfolios quite a bit. Lastly, what's going to hurt this market? Well, we already talked about the fact that unemployment's really a full employment. I mean, if you can't find a job in today's economy, you're probably not looking hard enough. So the Fed will have to continue to raise rates to slow down the economy a little bit. That with it, but they also, during the crash, we had what everybody called QE, where the Fed basically created liquidity in the market so that we can get going again. Well, they're reversing that now. And starting real soon here, they're going to be doing $60 billion in reverse of what they did before. That's $600 billion a year that's going to come onto the market. And we think that that's going to be something that's really going to slow down these financial markets. Somebody has to absorb that. And the question is, it's never been done before. So what will happen? We don't know. But we think there's some definite caution ahead when that starts to really take effect. One of the things that we'll do now is, obviously I just covered about what the Fed will do, but there's other things that are starting to worry us a little bit. Sentiment, which is how people feel about the markets right now, is pretty much an all-time high. I mean, it's unbelievable. The one good thing is that everybody covers on the news is how everybody's happy, everybody's enjoying, everybody's wonderful, and everybody's very positive towards the future. That's generally a good thing. But when it comes to markets, when everybody's in, when everybody's happy, when everybody's buying, then the other side is a little bit dangerous, and that's where we're at right now. It doesn't mean it'll happen tomorrow. It doesn't mean it'll happen next week. But it's those types of information, that type of data that we get in that tells us we have to be cautious going forward. And sentiment, like I said, it's the readings that we're getting today are incredibly high. The other thing that's happened that's really very interesting is we've had no volatility almost. Last year we had 52 days below 10 on the VIX, which is the measurement of volatility in the markets. Before that, the most we'd ever had in 1 year was 4. So that tells you everybody's being complacent, everybody's happy, everybody's wanting to buy the markets now. I'm getting clients that were scared of the market 10 years ago that want to buy. The market's fourfolded since March of 2009, and yet now everybody wants to buy it because people are always chasing returns. As a tactical investor, which is what we are, we tend to make sure that at that point when the market's really starting to flare up, that's when we get the most scared, and that's when we get the most cautious, and that's what we're looking at right now. So what I mentioned earlier, you will see this chart up on their screen, the S&P 500. You can see from the 2009 bottom, it's just screaming forward. That's a great chart, and there's a lot of money been made during that time, but it's also a very scary chart because the question is what's the next leg? I think it'll continue to go further, but the more and more it goes further, the more and more the pullback will be. We look at the sentiment chart, as you can see, when you do see it on the screen, you'll see it as one of the peak years that we've had in quite a while. It's a very scary chart for me. And lastly, the put-call ratio. Now, the put-call ratio basically is what the investors out there are, how they're protecting themselves or how they're aggressive. So if you're buying puts, then you're basically buying insurance against the market correcting. And the less of that there is, that means that there's more people less afraid. Well, when there's less people less afraid, that means that the bottom isn't protected, and you can see a correction or even a crash happen because there's just too many buyers and not enough sellers. And when the selling comes, there's just nothing to stop it. So that's another chart that you can see is peaking, and we do look at that very closely. Lastly, to wrap up, we do appreciate for those that are clients that we appreciate your business, and we're looking forward to 2018. We think that volatility will spike. We talked about how there was no volatility almost at all last year. We do think that changes this year, and Although January started out with basically no volatility and continued forward gains, we do think that before this year's out, you could see some significant volatility that we'll take advantage of.
Thank you, Jose, for your comments. And if you guys have any additional questions, don't hesitate to reach out. We look forward to communicating with you in the future.
Yeah, and remember always, we're just a phone call away, an email away, a text away. I have clients that text me all the time, and just give us a call if you have any questions. Everything we talked about today is in general terms. It doesn't necessarily portray exactly what we're doing in your particular portfolio. For that, we definitely need to talk over the phone or face to face. But give us a call, please. Don't be afraid to contact us and let us know how you're doing in life. I know we just recently got a call from one of our clients who we were able to help get a new car, and they were pretty excited. So that's always good news. We like to hear from you at all times. So let us know what's going on in your life and give us a ring.
Thank you for your time.